Good day to everyone seeing this video. Welcome to the channel. My name is Crown and I'll be your friend and tutor on this session. In this video we are going to be talking about the basic market structure in trading, and I'll be showing you a step-by-step explanation of the basic market structure. So before that, let's dive into a brief introduction of this basic market structure. One of the most important skills that you need as a trader is the ability to read the market structure. This is a critical skill that will allow you to use the right price action strategies in the right market condition. You are not going to trade all the markets the same way. You need to study how the markets move and how the traders behave in the market. And if you can master this skill, when you open your charts, you'll be able to answer this important question. What are the crowds doing? Who is in control of the markets, the buyers or the sellers? What is the right time and place to enter or to exit the market, and when you need to stay away? So what is this market structure? Market structure can simply be referred to as the study of the market's behavior. The markets move in three basic. We have the bullish market structure, the bearish market structure, and the ranging market structure. The bullish market structure are simply characterized by a repeating pattern of higher highs and higher lows on the chart. This is also referred to as an uptrend structure. The bearish market structure. The bearish structure are simply characterized by a repeating pattern of lower highs and lower lows. This is also referred to as a downtrend structure. Then for the last one, the ranging market structure. The ranging market structure are simply characterized by a bounce within key support and resistance zone. It is also referred to as a consolidation structure. So this is quite simple. When the market is moving to the upside, it's primarily an uptrend structure. And when we are having a bounce within two horizontal lines, then we can say that the market is consolidating rather, or the market is ranging at that point. Then when the market is moving primarily to the downside, we can say that the market is in a downtrend. So when we are in an uptrend, we basically just want to be buying, and when we are in a consolidation or in a ranging market, we just want to avoid the market or just stay away from the market at that point. Then when the market is in a downtrend, we want to be selling that market structure. So these stuffs are so important because people get caught trading in the wrong way. People may anticipate a sell in an uptrend structure or a buy in a downtrend structure. So that's the wrong way to trade. The best way to trade structure is to actually trade in line with the trend. So the best way to trade structure is to keep buying when the market is bullish and keep selling when the market is bearish. You don't want to avoid anything buy when the market is in a downtrend, and you want to avoid anything sell when the market is in an uptrend. So what do we need to do? We need to learn how to identify an uptrend and a downtrend, so we can buy with the uptrend and sell with the downtrend. So let's have a look at the anatomy of a trending market structure. So a trend is defined by a series of highs and lows, right? If the market is making series of higher highs and higher lows, we can say that the market structure is bullish. Alright, so this is our higher high, this is an higher low, higher high, and higher low. And on the flip side, when the market is making series of lower high and lower low, lower high, lower lows, lower high, and lower low, you can simply say that that market structure is bearish. Alright, so how do we identify the higher highs and higher lows? Well, we use what we call BOS. BOS, right? And BOS is an acronym for break of structure in trading. So once an high gets taken out, a previous higher high gets taken out, then we can see that the market structure is bullish. The previous higher high was taken out here, the market is bullish. Another higher high was taken out, it was broken, then we can see that the market structure is bullish. Then on the flip side, for the bearish market structure, when the lower low had been broken, then we can see that the market structure is bearish. Here again, the lower low broken, the market structure is bearish, a lower low broken, and the market structure keep bearish. So another thing to take note of is the market structure moves into phases. We have the impulsive and the retracement move. So the impulsive move is the trend, or is the move in line with the trend. So when we are in an uptrend, the impulsive move is the move that is also moving to the upside. Alright, so the impulsive move is a larger move that actually drives the markets in one direction, that drives the markets with the current trend. So then for the retracement move, it is the move that is not in line with the trend. So as we can see here, the market structure is bullish, right? And this retracement move is coming down. What does that tell us? It is not in line with the trend. But this impulsive move is going up, so that is in line with the trend. So impulsive move are the move that are in line with the trend, while retracement move are the ones that are not in line with the trend. Then for the bearish market structure, the impulsive move is the one that is in line with the trend. Alright, so impulsive move is the move from the lower high to the lower low, right? While the retracement is the move from the lower low to the lower high. So impulsive move for the bearish market structure is the move that pushes the market to the downside, that pushes the market towards the downside. While the retracement move in a bearish market structure is the move that pushes markets to the upside. Alright, so that is that. So the impulsive versus retracement explain the battle between the buyers and sellers. So buyers are in control here. For the bullish market structure, buyers are in control here. Then the sellers tries to push price downward a bit. Then the buyers were able to take control back and break their previous higher high, a break of structure, create a break of structure, and then sellers again try to take the control. Sellers try to push price downward. Then the buyers, since it's still their move, they take control again. On the flip side, for the bearish market structure, the sellers push price downward. Then the buyer tries to push price upward a bit, but they are not able to break price above here. Then the sellers again push price downward. Buyers try to take control. Then the sellers were able to get price moving downside again. So let's look at the chart example for this. So on this, I'll use this to explain the bearish market structure. So let's just, as we can see here, the price is in a downtrend. So we have a lower high here, a lower low, a lower high, a lower low, a lower high, a lower low. Alright, so what does that tell us? That tells us that this is our impulsive, no, this is our retracement, this is our impulsive, retracement, impulsive, retracement, impulsive. That's for the downside. So marking out our break of trust, so we are going to get something like this. Oh, I didn't get that. So we're getting something like this for the break of trust. So I will explain why this one is not a break of trust. So I'll do a video that explains why this is not a break of trust. So why that is not a break of trust. So they are valid break of trust. So and they are the ones that they are not valid. But nevertheless, I'll do a video on it. So it's a break of trust. So this tells us that this is our retracement for the downside, right? Since we say this market structure is bearish, so this is our retracements, impulsive, retracements, impulsive, retracements, impulsive. So we can tell that the market structure is bearish. So let's look for a bullish market structure example. So this one continues a lower high, lower low, 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 lower high, lower low. So this is retracements, impulsive, retracements, impulsive, retracements, impulsive, retracements, impulsive, retracements, impulsive, retracements, impulsive, right? So let's get an example for the bullish market first. So for the year we can tell that, okay, let me mark this out first. This is an uptrend, right? So this is our higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. Alright, so this is a break of structure. We should have a break of structure here, a break of structure here, a break of structure here. So that tells us that price is moving to the upside. Alright, so then this will be our impulsive retracements. Impulsive, remember I said the impulsive is the one in line with the trend. So since we are getting an uptrend, impulsive should be the one pushing price to the upside, while retracements are the move that will push price to the downside. So we have this as our retracements, impulsive, retracements, impulsive. Right, so I hope you guys were able to understand the logic behind the basic market structure. So if you enjoyed this video, make sure to subscribe to the channel and like this video, and turn on post notifications to get notified when a new video is uploaded.